In 2020, Ooredoo set out on a bold journey to reimagine connectivity and digital infrastructure, redefining its role in the global digital economy. And the results speak for themselves, with 5 years of disciplined strategy execution, delivering record profitable growth and strong performance. A value-focused portfolio, focused on delivering superior shareholder returns through strong market positions in attractive markets. In January 2022, we merged with CK Hutchison to create Indosat Ooredoo Hutchison. Only 2 years later, IOH has outperformed expectations, delivering exceptional growth across all key metrics. In May 2024, we completed the exit from Myanmar, streamlining operations and sharpening portfolio focus. A number of ambitious initiatives have propelled our digital transformation forward. We've successfully delayered the business with projects such as the launch of the largest tower company in MENA, valued at $2.2 billion, and the landmark creation of Syntys, a sovereign, AI-ready data center platform across MENA, in partnership with Iron Mountain. We also continue to advance financial inclusion through mobile-led solutions under the OFTI arm, which is live in 3 markets, processes over $6 billion in transactions annually, has a 21% of value share of MENA's mobile money transactions, has partnered with global giants, and has secured regulatory approvals in key markets. These bold developments have been underpinned by major collaborations, including with AI and computing giant NVIDIA, partnering on the region's first large-scale launch to accelerate AI infrastructure development. To power Ooredoo's continued digital evolution, we successfully executed 2 major financing deals in 2024, securing Qatar's largest ever technology financing in a 10-year, $2 billion facility with the country's biggest banks, as well as raising an additional $500 million 10-year international bond issuance, reiterating continued global investor confidence. We have also expanded our core infrastructure investments, with projects such as the Watershed Fiber and Gulf project, connecting Oman, UAE, Qatar, Bahrain, Saudi Arabia, Kuwait, and Iraq in the GCC's largest ever subsea cable project. And all this sustained business momentum, consistent cash generation, and the board's confidence in our strategic approach has led to the approval of a new dividend policy, increasing the target dividend payout range from 40 to 60% to 50 to 70% of normalized net profit. Today, Ooredoo stands as the region's leading digital infrastructure provider, ready to power the next decade of digital growth across MENA and beyond.
Good afternoon and welcome to Ooredoo's 2025 Capital Markets Day. Today, we're excited to share a closer look at Ooredoo Group's refreshed strategy, our outlook on key growth areas, and our continued commitment to delivering sustainable long-term value creation. My name is Luelle Pillay and I'm responsible for investor relations here at the group. It's a pleasure to have you with us today. Let me take a moment to walk you through today's agenda. Our program is shaped around Ooredoo's refresh strategy and long-term growth ambitions, featuring insights from our group leadership and country CEOs. We'll begin with a business overview from our group CEO, followed by a deep dive into our refresh strategy presented by our Group Chief Strategy and Acting Chief Consumer Officer. Then we'll shift gears with our CEOs from Qatar, Iraq, Kuwait, and Algeria sharing insights into their respective markets. We'll then turn our attention to the digital infrastructure platforms, featuring a closer look at our data center company Syntys, presented by its CEO. Our Group CFO will then review our financial performance and guidance before we conclude with closing remarks from our Group CEO. Finally, we'll open the floor for an interactive Q&A sessions. All presentations are available on our investor relations website and on this platform. Our speaker bios can be found on our website. And as always, we greatly value your feedback. A short survey will appear once the webinar concludes, and we would appreciate you taking a few moments to share your thoughts on today's events. Before we begin, please take note of our usual disclaimer, particularly regarding forward-looking statements and the normalization of the numbers presented in today's slides. The recording and transcription of the session have started, and by attending, you consent to being included. Finally, please remember to use the Q&A function in Zoom to submit your questions at any time during the session. So let's start. It's my pleasure to introduce Aziza Luthman Fakhru, Ooredoo Group's Chief Executive Officer. Aziz will provide a comprehensive business overview highlighting the progress we've made over the past years. I'm sure you won't meet many telecom CEOs with such a diverse background. Aziz has extensive experience in finance, investment banking, and mergers and acquisitions, having worked in Paris, London, and Qatar. He was a board member of Ooredoo for more than a decade and has been leading the group as CEO for the past 5 years. Handing over to Aziz, who will officially kick off Ooredoo's 2025 Capital Markets Day.
Good afternoon, everyone, and welcome to Ooredoo's Group 2025 Capital Markets Day. As a management team, we are proud to present Ooredoo's journey to a record-level profitability, a clear reflection of the disciplined execution of our strategy, our focus on digital transformation, and our commitment to creating lasting value for our shareholders, customers, and communities. Over the past years, we have transformed our businesses by streamlining our portfolio to strengthen our core, delayering our infrastructure stack, building strategic partnerships, and driving greater efficiencies across the group. With a stronger foundation now in place, we are scaling our verticals and positioning Ooredoo to become the leading digital infrastructure provider. The results we will present today speak for themselves. Ooredoo today stands stronger, more agile, and more digitally empowered than ever before, positioned to capture new opportunities across our market. Today, we will take you through how we achieve these results and, more importantly, how we plan to sustain and accelerate this momentum in the years ahead. Whether you are new to the Ooredoo story or familiar with our journey, today we will take you through our growth story, transformation, and diversification outlook. Let's start by looking at where we are today. We have a diversified footprint across 9 countries in the Middle East, North Africa, and Southeast Asia regions, including our joint venture operation in Indonesia. Our footprint has a fast-growing population of over 400 million people and nearly 100 million households. We have a highly scaled operation with nearly 150 million mobile and broadband subscribers and a consolidated revenue of $6.5 billion. Most importantly, we maintain leading number 1 or number 2 market position in 7 of these 9 countries, thanks to our scale and best-in-class operation. Let's take a closer look at our markets across our diversified footprint. In our markets, which are typically 2 to 3 player environments, we have a leading position in 7 out of 9 countries, providing both scale and competitive advantage. Even in markets where we are ranked 3rd, Kuwait and Algeria, we are delivering top-line growth and healthy profitability. Our business model is customized to each market, providing mobile and fixed wireless services with wireline broadband available in select locations. Our portfolio is well-balanced, combining highly rated GCC markets such as Qatar, Kuwait, and Oman, and high-growth markets such as Iraq and Algeria. From the bar chart, you will note that over half of our revenue comes from GCC market, providing stability and recurring cash flows, while high-growth markets contribute to the remaining, driving momentum for future growth. It's worth highlighting that 76% of our revenue comes from markets tied to the US dollars, offering both stability and financial predictability. Here's how we shaped Ooredoo in the group we are today. Our journey began in 1998 with the stock market listing of QTEL, the predecessor of today's Ooredoo. Between 2004 and 2013, we expanded internationally, building on our success in Qatar. In 2018, we successfully launched the world's first 5G network in Qatar, reaffirming our technology leadership. From 2021 onwards, we have been focused on portfolio optimization and execution of our digital infrastructure strategy. Through the IOH merger in 2022 and our Myanmar exit in 2024, we strategically redefined the group's focus and growth trajectory. I'll expand more on the impact of this later. We have also achieved significant milestones in carving out and expanding our digital infrastructure and platform businesses. Today, Ooredoo has a strong foundation, a focused portfolio, clear strategy, and a healthy balance sheet, well positioned to deliver sustainable growth. Simply put, the results speak for themselves. And we can see here on these charts that since 2020, we have delivered on the board's mandate to strengthen the core and grow Ooredoo. We have achieved an uplift in compounded top-line growth of over 3%, while improving and sustaining our margins to well above 40%. We have continued to make disciplined and strategic capital investment with CapEx intensity of around 16% across our platform. We have been able to significantly enhance our returns with both ROE and ROIC nearly doubling since 2020. We have achieved all of this growth while significantly reducing our leverage ratio from 1.7x to 0.6x and maintaining high investment-grade credit rating. Our strong financial performance has also translated into superior returns for our shareholder. We have maintained consistent growth in our dividends, paying towards the upper end of our existing policy range of 40 to 60% of normalized earnings almost every year since 2020. As a result, our dividend per share has increased by 160% during this period. This, coupled with the growth in our share price, has contributed to delivery of nearly 120% total shareholders' return since 2021. Our strong performance to date underscores our ability to create value and to see further upside, as reflected in the last week proposed increase to the dividend payout ratio, reinforcing our commitment to delivering value to our shareholders. These moves in IOH and Myanmar highlight our disciplined approach to value creation, focusing on markets where we can lead, scale, and deliver stronger return. In Indonesia, the IOH merger created a national scale operator with strong market position and improved financial performance. Since closing, IOH has delivered over 25% share price growth, solid revenue and margin expansion, as well as $462 million in synergies, exceeding both timeline and projection. We maintain full operational oversight of IOH, even if its results are not fully consolidated. Our strategic exit from Myanmar reflects disciplined portfolio management, focusing on core high-growth markets and redeploying capital where it creates more value. These moves reflect a clear, active strategy in managing our portfolio, enhancing scale, focus, and shareholder returns. At Ooredoo, our focus is creating value, not simply expanding our footprint. This is what sets Ooredoo apart for investors, and the upcoming presentation will delve into the details. We are a regional digital connectivity leader with strong market positions and generally rational competitive environments. Our portfolio combines high, stable, and cash-generative markets with markets that are growing strongly, supported by a healthy balance sheet and consistent returns. We operate with a well-invested superior network, premium brand, and strong focus on customer experience, ensuring competitive advantage across our markets. We have a comprehensive digital infrastructure platform and a customer-centric strategy that position us well for future value creation as the industry continues to evolve. I want to emphasize that we fully own our digital infrastructure, including data centers, towers, and fiber networks. And behind all of this is an experienced management team driving operational excellence, digital transformation, and long-term value for shareholders. To summarize, Ooredoo combines scale, stability, and growth, built to create lasting value. We'll touch on all these themes again as we go through the presentation. Thank you.
Our next presentation is by Renee Werner, Ooredoo's Group's Chief Strategy Officer and Acting Chief Consumer Officer. Since joining Ooredoo in 2021, Renee has overseen the group's strategy, digital services, and carve-out initiatives. He brings more than 25 years of experience in the global telecom sector. He'll now take us through a deep dive into Ooredoo's refresh strategy, which sets the stage for our next phase of growth. I won't steal Renee's thunder by saying any more. Over to you, Renee.
Good afternoon. Welcome also from my side to our Capital Markets Day. I first take a quick look back with you on our strategy that we have been executing over 4 years since 2021, which we dubbed at the time Smart Telco. As you can see in this chart, the strategy was focused on 5 particular areas where we have delivered strong results. Let me quickly highlight these 5 areas. Customer experience. For us, absolutely a prerequisite to positive business outcomes are happy customers. Our customer satisfaction has improved sharply, with NPS across the group up nearly 15 points. Voice of customer satisfaction reaching 75% and improving further. People as the next topic. Delivery of business outcomes is only possible via a strong organizational fundament. We've built a leaner, more agile organization focused on accountability, delivery, and performance. Smart Telco, evolve the core. We have augmented around our core telecoms business with a digital service business with revenues now up more than 70% versus 2021, and substantial contributions from there to our free cash flow. We are ready for telco as a service business models with more than 300 APIs that we have built that follow TM Forum industry standards. Strengthen the core, another area. We've achieved 17% EBITDA growth and a 32% increase in free cash flow between 2020 and 2024 as an outcome of various initiatives addressing efficiency opportunities and top-line growth. Last but not least, value-focused portfolio. We've deliberately and diligently invested in our assets to expand our market positions in an industry that is driven by scale. I'm happy to report that we have expanded both mobile service and free cash flow market shares, indicating our strong competitive performance across our markets. In addition, we took conscious choices with a disciplined portfolio management. We exited Myanmar, executed the IOH merger to build a strong number 2 in the Indonesian market, and to the creation of a digital infrastructure and fintech carve-outs, we have created optionality in our portfolio. In summary, these results speak a very clear language of execution across all pillars of our previous strategy, with the outcome of a stronger core, a sharper portfolio, and a more digital, customer-focused Ooredoo. Now let's talk about value creation. The underpinning and motivation of our strategy we've been following in the last 4 years is that our industry has a checkered history in efficient capital deployment. As a team, we took this as a challenge to show that this can be done different, with rigor and science in capital deployment, with driving additional use of assets we had already deployed, by exploring efficiency opportunities, and by conscious decisions across the value chain where we are present and where we leverage strong partners. As Aziz mentioned, our strategy in the last 4 years, as well as our strategy going forward, has been and will continue to be focused on delivering superior returns on our invested capital. Our strong focus on value creation has been evident by consistent growth in our return on equity and our return on invested capital metrics. Ooredoo's return on equity has more than doubled since 2020, moving from 6% to over 13% in the last 12-month period. We usually track the top 60 telcos globally, and this is firmly positioning us among the top half. Return on invested capital has also significantly increased, going from below 8% in 2020 to nearly 13% in the last 12-month period, which also gives us a firm position in the top half of the top 60 telcos globally that we track. Our portfolio is well positioned for further growth. Our focus on value creation and organic profitability, increased asset utilization and capital discipline is basically the fundament of a good outlook that we can give you. The value creation that we have been able to drive is also an outcome of this portfolio mix, which is rather unique among telcos. Our markets are at different stages of maturity, providing a healthy mix of growth and stability. In our growth markets like Iraq or Algeria, we continue to expand by capturing new customers, driving data usage and digital adoption. These markets are key engines of future revenue and subscriber growth. In our growth to mature markets, Kuwait and Tunisia, we have focused on building customer lifetime value, growing ARPU through usage growth and upselling, strengthening our B2B capabilities and offers for that segment, and deepening the digital engagement with our customer base. Now, in our more mature markets such as Qatar and Oman, our focus is on maximizing customer lifetime value, strengthen the customer experience, strong CVM practices and loyalty practices, selling add-on services, penetrating deeper into the B2B market with solutions, and focusing on operational efficiency. We benefit, such as in Qatar, from strong market leadership, stable cash flows, and high operational efficiency, which provides the financial strength and predictability that underpins the group performance. If we now move over to the market dynamics in our footprint markets, the portfolio we just talked about represents markets with strong underlying fundamentals. This is unfortunately sometimes missed, and I would like to point out a few key strengths of our markets. The weighted average GDP growth across our markets is about 4.4%, well above global averages. We expect the GDP growth, also in the future, to be supported by young and expanding populations, with nearly 1 in 5 people under 25. In addition, these young populations are also a key driver of digital adoption. Relevant for a telco, data usage continues to surge across our portfolio, growing at a CAGR of roughly 14%, reflecting rising digital consumption and smartphone penetration, in particular where mobile networks are the key enablers for access to the internet. Even more relevant for telcos, beneficial price elasticity, which is absolute rare in our industry. This is in sharp contrast to many European and other developed markets. As said, we're different in our markets. As customers use more data, revenue grows, especially in markets like Algeria and Iraq with a beneficial price elasticity. What does that mean in summary? Together with the portfolio we discussed earlier, our markets have very healthy macroeconomic conditions as well as favorable conditions for a telecom like Ooredoo to generate growth. Our portfolio is uniquely balanced across markets, maturity levels, and our position in those markets. We should be uniquely positioned to perform through cycles and capture future opportunities. Together, this creates an optimal mix of assets, delivering both recurring cash generation and sustainable long-term growth across the portfolio. So now you might ask yourself the question, where are we headed with Ooredoo after we reached a substantial milestone with our Smart Telco strategy? Let me shed some light on this. Ooredoo's refreshed strategy, we have evolved our strategy and we dub it RISE, essentially combining 3 investment horizons that are aimed at providing superior shareholder returns and growth, and to guide the evolution of our business model towards a leading digital infrastructure provider. The refreshed strategy focuses on driving the core telco business forward with leading practices in data science, AI, CVM, and other areas. It rests on further scaling the digital infrastructure business, and also it focuses on developing and expanding platform businesses in core adjacencies where Ooredoo can bring an advantage to the table. Under the umbrella of RISE, we have developed various growth and efficiency initiatives in the 4 clusters you see here: refresh, intensify, scale, and expand, which are since early 2025 advancing and have started already contributing to our results. The flywheels are underpinned by a set of foundational enablers that ensure long-term success. People, as we mentioned earlier, an AI-driven transformation which we drive with a group-wide program dubbed Fanar. That means in Arabic, lighthouse. Competitive networks and IT. And most importantly, that is where the heart of the company is, excellence in customer experience. Let's now zoom into the 3 investment horizons that are key to RISE as the refreshed strategy of Ooredoo. So you see here in the overview 3 areas. I start first with core telco. We serve today nearly 150 million subscribers across 9 countries, including our affiliate in Indonesia. Today, this business represents the essence of our business in Ooredoo Group and represents today 96% of group revenues. We have strong market positions across our countries and presence, and have been, as mentioned earlier, be able to advance our market positions across most of our markets. Our ambition is clearly to lead our markets in customer experience, providing the leading data experience in our markets, and to be the preferred partner for digital service players in our markets so we can provide our customers with the leading propositions in the market. Usually we are able to leverage strong brand positions in all of our markets. Business priorities in core telco center around continuous improvement of customer experience, creating a loyal customer base and driving growth via customer value management and applying latest data science and AI models to capture both efficiencies and growth opportunities. Capital deployment discipline is strongly underpinning this part of our business. If we now talk about digital infrastructure, the group is systematically scaling its digital infrastructure platforms to benefit from the unstoppable trend towards digitalization, cloud services, and data usage growth. We focus in essence on 3 core platforms. Data centers. We have nearly 30 megawatt of capacity in our data centers today, with clearly articulated expansion ambitions and projects as well as investments. AI lives in data centers, and our region has a substantial pent-up demand for data centers. We are prepared to cater to this demand, and we'll later talk about Syntys as the home of our data center ambitions. Sea cable and transport fiber. AI and the internet need to make data available across borders. For this, high-speed internet connectivity across borders is required. We have already interesting assets in this context and have started to build a unique portfolio of assets on top of that, providing in-region connectivity, but also key routes for data between Europe and Asia. Towers, as the last building block, you have heard about this from us previously. We have announced the formation of the leading tower platform in the region with our partner in this. Today, this platform would have more than 30,000 towers ready once regulatory approvals are received. Last but not least, a key pillar as well for our long-term success are platform adjacencies. Around our core telecoms business, we have constantly emerging opportunities that lend themselves to a platform play in the markets we operate. We selectively pick those where we think we can genuinely bring advantages to the table as a telco, be it access to our broad sales network, be it data insights, be it our large partner network. Again, we do these choices very selectively. The fintech platform expanding beyond our established Ooredoo Money business in Qatar or M-Faisa in Maldives is one of the examples. We have launched this business also in Oman in 2024, and there is more to come on this. More to come in this area, as I said. We pick selectively, limit our initial investment exposure during an experimentation phase, but are willing to invest once we see expected upside materializing, and with this, the crystallization of shareholder value. Today, 95% of our business belongs to the core telco pillar. We plan to grow both the digital infrastructure pillar and our platform adjacencies to represent circa 15% of our revenues in 2030 from today's roughly 4%, as you can see in the chart. Now let's have a look at our core telco business as the first flywheel that today generates 96% of our revenues and the approach we take here. We want to build a self-reinforcing cash engine in our core telecoms business. Despite a solid growth in the telecoms business in our markets, and that is still available, our strategy considers the increasing levels of maturity of our markets. Topics like superior customer experience, leading practices in CVM and churn management, digital distribution become even more relevant in this market phase. This is reflected in our strategy for the core telecoms business. Let me give you an overview of the 5 key components of this strategy for the core telco business. The key underlying product we sell is data connectivity. We invest into leading data networks and an agile IT as an enabler to make this connectivity easily accessible. The outcome of which should be a superior customer experience that allows us to attract customers with our core proposition at a more efficient use of sales resources and also create a solid fundament of customer loyalty. Branding and distribution excellence is the next area of focus. Excellence means, on one hand, driving brand preference and purchase considerations, and secondly, being present where it matters to sell, digitally online or physically in shops. This should result in an ability to capture the demand that is ideally lined up already, win new customers or sell more to existing customers. Not last and not least, churn management excellence as the third pillar. Once we have won the customer, we have to earn his trust and business through repeat purchases. There's no point in winning the customer and losing him or her again. Loyalty programs, deep customer insights, and state-of-the-art churn avoidance models are key to be successful. If executed correctly, we should see a growth in our customer base, not SIM cards, but customers. If we're at that stage, it's the question to ask, how can we create value out of the base? Upselling customers to products that might even fitting better their needs than the initial purchase. Selling customers new products from our partners and winning over also additional business from him or her or a respective enterprise that we can kind of move forward. A strong commercial extraction or monetization is key to this. Together with cost discipline in operations, focusing on spend where it really matters and where it is a priority, and being frugal where the priorities might be different. That should yield a strong free cash flow generation. At Ooredoo, we have improved our free cash flow yield over the last years substantially, and we continue to find further opportunities in our core telco business. Nevertheless, core to Ooredoo and the success of our business are happy customers based on a superior customer experience. Now, let's kind of have a look at our assets that we consolidate under Ooredoo. We operate the flywheel across a diverse set of markets. What you can see here is twofold. On the very right hand of the chart, you see our focus on building and operating leading data networks in the markets we operate in to provide superior customer experience. The bar to the right indicates we have the leading network. Second, our focus on driving multi-product penetration as a function of customer trust, loyalty, and our abilities in CVM and data science, which then in return drives revenue growth. We have really solid growth across our operations as well as strong market positions developed in the last years. So let me now give you a little few pointers back to the flywheel that we discussed, how we walk the talk at Ooredoo. Let me start with network investments. Fast internet speeds and wireless are dependent on fast backhaul of the data traffic from our sites where the customer connects, literally to the core network and from there to the internet. The more sites you have fiberized with fiber at the base station, the better you can do this job for the customer. We've invested substantially in fiberizing our mobile sites, crucial for fast connectivity. More than 50,000 of our sites are fiberized, and more than 23,000 of our sites are one hop away from the next fiberized site. That gives us the ingredients to provide high-speed networks and excellent coverage. This is also dependent on your spectrum holdings. In our markets, we have a very solid position with spectrum holdings in several markets that are second to none globally. This not only has led us to hold global leadership positions, pioneering globally 5G in Qatar, for example, but also having the second fastest mobile network on the planet, according to the speed test provider Ookla, also in Qatar, with Qatar operations being number 2 globally. Let me move on to branding and distribution excellence. According to AC Nielsen, which measures brand strength for us, we're in 6 out of 8 of our consolidated markets, the number 1 brand on Brand Equity Index, which gives us a more than solid position for being considered by our customers for purchase. We've substantially leveled up next to the brand, not only our ability to measure, but more importantly, our capabilities to provide a superior customer experience at our touchpoints with the customer. We're listening and learning daily from our customers and try to improve our operations with the insights provided from this feedback of the customer, which has both beneficial outcomes for our ability to grow revenues and avoid cost. We are also substantially progressing our digital sales and distribution agenda and still have a good runway for growth. This runway will have both beneficial impacts on customer experience, data insights, and our ability to cross-sell partner services, and ultimately also to capture cost efficiencies. Now let's have a look at the other levers of the flywheel, which we haven't covered yet. Churn management excellence that we pointed out earlier. As our markets shift from a state where the strategic paradigm was to capture customer growth fast to a state where retaining customers becomes more important, we level up our capabilities now in churn management. We are leveling up already with good data science practices for churn management and are strongly focusing on multi-product penetration, to which I will speak after this. We're at the first stage of many in this area, but we see promising results on which we want to aggressively build further. Beyond this, we have been an innovator in our markets with attractive loyalty programs such as Nujum, and will refresh that leadership with these programs providing interesting lifestyle benefits for our customer base. Not last, also not least, customer value management. As already pointed out, our markets are shifting in a new phase. Capabilities in data science and AI provide upside opportunities to improve monetization from our customer base. Providing the right offer at the right time through the right channel is crucial. Across Ooredoo, we have laid strong foundations that show strong first results, as you can see on the chart, with significant contributions. This is the start into the journey and not at all the end of it. We see here substantial further opportunities, and this is for sure a strategic focus area for us. Last but not least, cost efficiencies. We've established strong practices in the past years with our initial programs like Braveheart that we shared earlier, and additional programs that followed. We make deliberate choices along our value chain based on detailed cost benchmarks, structural decisions on in or outsourcing, and also leveraging AI increasingly in our daily operational workflows to drive efficiencies. Our numbers and our margin levels speak for themselves. As always in life, we will keep working on this topic to stay on top of our game and leverage new opportunities that are emerging, such as AI, for our operations. On this note, I want to mention that we have established a group-wide AI program dubbed Fanar to allow for experimentation, but also fast scaling and rollout of AI opportunities across Ooredoo. You will hear more about the practical side of this later from my colleague Amar Suna when he speaks about Asiacell. Now let me highlight also in my role as Chief Commercial Officer for Ooredoo a topic that is of substantial strategic and commercial relevance: our multi-play framework. As said earlier, our markets are increasingly shifting into a mode where selling another SIM card becomes a game of decreasing returns. What drives returns is to provide customers with an extended set of products from Ooredoo or partners. This approach helps not to only uplift the revenue from our base, but even more importantly, positively impacts the loyalty of our customer base with markable impact on revenue growth and profitability. As you can see, customers in the multiplayer dual play category, this is roughly 50 to 60% of our customer base, have an overproportionate share of revenues 80 to 85% as a rule of thumb, and an even higher share of customer lifetime value, 90 to 95%, when loyalty is considered. The logic is very simple and compelling. The revenue per customer, ARPU, is substantially over-indexed against the average. As you can see, 70%, 40% higher than the average, while the churn rate are massively under-indexed. Gaining customers in these two segments is hence a strategic and commercial priority and opportunity. This becomes even more interesting if you can attract, via superior customer experience, also competitor customers in these two segments. The framework strongly guides our market activities going forward and has been already established. We've shifted with this from the old grow SIM cards paradigm to grow value, or in specific words, customer lifetime value, CLV. Execution ingredients reach, without being exhaustive in this, from the already mentioned loyalty programs to leading data science and CVM practices and attractive product portfolios with digital service partners as one example. Let me now come to one growth field that is frequently overlooked in our industry but provides excellent growth opportunities if approached right. This is SMBs. Small, medium-sized businesses sometimes get lost between the artificial segment boundaries in a telecom, between consumer and business units on one hand. And they expose traits of both. They require not a some of this, some of that approach, but a dedicated focus. And Ooredoo wants to have that dedicated focus. We want to be here, the one-stop shop provider that allows SMBs to focus on their business while we take care of their connectivity and solution needs. With regards to Ooredoo, we want to put a much stronger emphasis on this segment where we feel we are currently under-indexed and can capture market share. The SMB SOHO segment represents a strong growth opportunity for the company, with today roughly 0.3 billion in revenue in 2024. For this segment, we will package our classical connectivity products more strongly with offers from our digital service partners that cover the basic needs of SMBs in the digital economy and make those available through digital marketplaces. Examples of the products that we intend to offer is, next to our core connectivity offer as a mobile player, also fixed products, complemented by digital services for SMBs, such as basic cloud storage, off-the-shelf software bundles, cybersecurity solutions. The ambition is to grow SMB revenues by around 50% over the next 4 to 5 years, driven by selling beyond our mobile connectivity, fixed connectivity solutions and digital services from our partners. For completeness, I want to also mention here our other B2B services, not only for SMBs, but also for large enterprises such as Qatar Airways, QNB, Volkswagen, or Tesla, that are delivered together with our strategic partners, top companies like NVIDIA, Cisco, Microsoft, Google, Fortinet, where we can serve as a one-stop shop for our enterprise customers. With this, I hope I was able to give you a good overview of the strategic direction for our core telecoms business. We'll talk later also about our approach for the 2 additional investment horizons, or flywheels, if you prefer this. But before this, I want to make sure you hear from my colleagues how we execute what I lined out in our strategic section. Let's have a quick look what you will see now. For this, we have today 4 country operations with us, where my colleagues will introduce you to their markets and the specific strategic approach in these markets. The markets have today with us present 4 archetypes in the portfolio, characterized by their market position and the growth profile of the market, which each uniquely gives us an insight how we act in this particular archetype. With market leaders like Qatar and Iraq, where we hold very strong competitive positions and deliver strong operational performance. Qatar stands out as a mature, high-value market, consistently generating significant cash flows and profitability for the group. Iraq, on the other hand, is a leader in a fast-growing market, combining scale, strong demand, and remains self-funded. In the key contender segment, we have Kuwait and Algeria. Kuwait presents a transition market, combining elements of both maturity and growth, where we're strengthening our position through premium services, digital innovation, and an expansion into B2B. Algeria continues to deliver solid growth, supported by rising data usage and focused infrastructure investments, sales expansion, and introducing successively new innovations with an impending 5G launch. Together, these markets reflect a well-balanced portfolio where Qatar's cash generation is complemented by the growth momentum of markets like Algeria and Iraq and the evolving potential of Kuwait. With this, I hand over to our country CEOs that will take you individually through a deep dive of the 4 markets, outlining the macro and market landscape, their competitive strengths, the key achievements, and the value creation priorities. Back to you, Luel.
We'll now shift our focus to our OpCo CEOs, starting with our home market, Qatar, which contributes 30% of group's revenue and 34% of adjusted EBITDA. It's my pleasure to introduce Sheikh Ali bin Jaber Al Thani, Chief Executive Officer of Ooredoo Qatar. Sheikh Ali joined Ooredoo Group in 2013, has held multiple senior roles, and has been leading Ooredoo Qatar as CEO since January 2023. Let's take a closer look at Ooredoo Qatar.
It is a privilege to welcome you to this year's Capital Market Day. Today, I'm delighted to share with you the story of Ooredoo Qatar, a company at the heart of this remarkable country's digital transformation and economic progress. Let us begin with a broader context. Qatar stands as one of the world's most dynamic and resilient economies, with a population of approximately 3.1 million. We operate in a market that is not only young and tech-savvy, but also deeply committed to innovation and equality. Our consumers are digital first, demanding premium services and setting high expectations for excellence. Turning to Ooredoo Qatar, we are proud to be the market leader in both mobile and stationary broadband. We serve around 2.6 million mobile subscribers, holding a 64% market share and command 74% of the stationary broadband consumer subscriber market. A key highlight for our investor is our ARPU, which remains one of the highest globally at $28. This figure is not just a number. It is a reflection of our premium market positioning, the strength of our brand, and the trust our customer place in us. High ARPU is a direct result of our focus on quality, customer loyalty, and our ability to deliver differentiated value-added services. It signals robust revenue generation and underpins our financial stability. Our strategy is clear and forward-looking. We are shifting from focus on volume to a focus on value. This means deepening our relationship with customers, expanding our multi- and dual-play offerings, and personalizing experience to meet the diverse needs of our community. Our Najoom loyalty program is a cornerstone of this approach, rewarding long-term engagement and enforcing our leadership among high-end customers. Our ICT capability are a major driver of our growth and innovation. Ooredoo Qatar is a strong ICT presence in the country, supporting national initiatives such as the Smart City Platforms TESMO. Through our advanced ICT solution, we are enabling digital transformation across sectors, empowering businesses and contributing to Qatar's vision of a knowledge-based economy. Our ICT portfolio is expanding, offering integrated solutions that address the evolving needs of enterprise and government, and positioning Ooredoo Qatar as the digital backbone of the nation. Underpinned by sustained investment in technology and infrastructure, we have rolled out extensive 5G and fiber networks, achieving over 99% household fiber coverage and delivering some of the fastest network speeds globally. Our network covers 99.9% of the population on 4G and 99% on 5G, with balanced traffic between both technologies. These investments ensure that we remain at the forefront of digital connectivity, supporting Qatar's ambitions as a smart, connected nation. Our digital ecosystem is thriving. My Ooredoo app users have grown to 1.3 million, and digital recharge penetration has reached 61%. These figures are not just numbers, they are a testament to the growing digital engagement and the trust our customers have in our platforms. At the heart of Ooredoo Qatar's success is our unwavering commitment to customer experience. Our Net Promoter Score stands at 41, customer satisfaction at 82.3, and the Brand Experience Index at 5.3, all reflecting the loyalty and advocacy we have built. We are not just the technical leader, we are the experience leader connecting network excellence with customer trust and engagement. Our customer base is highly diverse, segmented by socio-demographics and customer lifetime value. We have moved from one-size-fits-all approach to a precision-led, data-driven, value-focused business model. We employ the use of sophisticated data science modeling and AI to better understand the needs of our customers and their behaviors. This allows us to identify and prioritize high-value segments, tailor offerings, and create more personalized experience. It is a shift that is fully operationalized across our organization, driving loyalty and growing quality over quantity. Financially, Ooredoo Qatar is a powerhouse. We have maintained robust top-line growth with a 0.2% CAGR since 2020 and consistently strong EBITDA margin above 50%. Our revenue mix is well balanced, approximately 46% from mobile, 44% from fixed broadband, and the remainder from wholesale and equipment. Our disciplined approach to investment and cost control ensure we remain highly cash generative, supporting both our ongoing innovation and our contribution to the wider group. Our outstanding position in the market translates into strong financial and operational performance, underpinned by robust stability and high cash conversion. Our strategic foresight in infrastructure investment has positioned us exceptionally well for the future, allowing us to maintain our technological advantage while decreasing overall capital intensity. In summary, Qatar is a stable, high-value market, and Ooredoo Qatar is proud to lead it with scale, discipline, and consistent performance. We continue to evaluate emerging technologies such as AI to identify relevant use cases for both internal productivity benefits and to bring solutions to the market. For the investor community, the message is clear. Qatar offers a unique blend of opportunity, resilience, and growth. Ooredoo Qatar stands ready to capture this potential, delivering value for our customers, our shareholders, and our country. We are excited about the future and remain committed to driving innovation, operational excellence, and sustainable growth. Thank you for your trust, your partnership, and your belief in Ooredoo's Qatar story. Thank you.
Next, we have Amr Al-Suna, Chief Executive Officer of Asiacell, who has been CEO since September 2013. Asiacell, our Iraq operation, contributes 23% of group revenue and adjusted EBITDA. Over to you, Amr.
Assalamu alaikum wa rahmatullahi wa barakatuh. Hello everyone. I'm happy to be here with you to present Iraq and to present our performance in Iraq. Iraq is a great country. When we look at the growth and the population and we look at the way it's been evolving for the past years, it shows a very beautiful story for the future. The government took a great initiative to go into digitization and to push the digitization in Iraq. Asiacell played a major role as one of the main pillars for this growth, and we are part and proudly part of shaping the future of Iraq. Iraq population is 44.4 million people. It's a youthful country. The population of youth is around 28% with a growth of 2.4. This is driving demand on the network and driving demand for data. GDP per capita is a lovely story. Looking at the growth, it's a sustainable growth with controlled inflation. This gives lots of trust from investors to come into Iraq and invest, and we've seen that in the past couple of years. We look at the currency has been stable for the past 3 years, and this is a positive sign for us. Looking at the market, the mobile market is a 3-player market today. We're so happy to say that we are dominating the market when it comes to revenue and on all other KPIs, be it EBITDA, be it margins, be it free cash flow and net profit. The story of ARPU is a beautiful story looking at it. We've been able to sustain our ARPU even with the prepaid market growth happening to us at 6.1. It's higher than our competitor in the market and higher than the emerging market average. Penetration is at 100%. It's a prepaid market, as I said, and the potential is big to grow more with the demand and with the growth of the population happening. The broadband market is still not matured yet. This gives us way ahead to be able to push our broadband services and take more of the broadband market share. Leadership. Ageasol is by far leading the market, and it's positioned at the major position #1 player in the market. This was based on a couple of major pillars that we're looking at it. As I said, it's a fast-growing market as Iraq market. We have been able to dominate this growth. If we look at the data growth coming, it's not only about the growth of data by itself and the growth of revenue, it's all the other pillars that are compiling together to deliver this results. We start by a strong distribution capability at the channel, making sure that we take good care of our customers and we deliver the service needed to those customers at the touch points. Network leading position, it was done, and we've been always leading in that domain. If we look at the country today and our coverage, we have a full coverage on 4G. We own right now, based on Facebook market share, around 53% of the 4G market share, and the network is ready to activate 5G services. On the operations, we are focused as management and we're driven by shareholders' expectations. We're controlling our margins. We've been able to hold a very positive growth when it comes to revenue with a controlled margin to deliver a beautiful free cash flow to our shareholders and to have a self-funding operation when it comes to investment and comes to the rollout of our network. As I said earlier, it's a prepaid market where almost 97% of the market is prepaid. When we look at the ARPU, as I mentioned earlier, ARPU is stable for the past years. We had a little bit of a dip during Corona time, then we picked up and we went back to the 6.1. Growth of subscriber is a beautiful story. As I said, the country is youthful and it's still growing. We are seeing right now a projection that hopefully we will be able to hit 20 million by end of 2025. The other main thing that is adding value to our revenue growth and revenue leadership is the mix of the base. We're trying, and if you look at the top tier customer segmentation, the multi-play customers are increasing year after year, and this is the strategy that we've set long time ago to move our customers slowly but surely into the multi-play arena where they can add more value and they can create more value to our shareholders. As our customers are mainly driven by youth, we have a major expectations coming from our customer base. They want to have a sustainable, reliable network that can serve their demands. Looking at our network, as I said, we have a majority of the traffic is going into the 4G. We see major growth when it comes to data consumption. And on top of that, we've been able to dominate the leadership from network performance point of view by maintaining Ookla speed score above 19.3% over competition. If we look at the traffic contribution, it's 94% going into 4G. This helps us to monetize and to efficiently manage our investment and manage our capital invested into the network. If we look at network deployment in Iraq, we have limited resources. We have almost 98 megahertz available for us if we compare with other countries. But if you look at the efficiency and the way we're implementing our networks, it's a 0.2 intensity level. And this shows that our investment is done in a proper manner with a very high return on investment. Fiberization is still a massive potential in Iraq, and this is a major need that we will push, and we're pushing for it for us to be ready when it comes to 5G implementation. Customer experience, it's been always a direction, it's been always a focus area for us. If you look at all the KPIs that are around customer experience, you've seen the massive enhancement and improvement that we've done, starting by NPS, going into the CSAT, brand experience, and moving into the application at Ooredoo Group and the digital recharge. Though all the KPIs are going into a very high growth and very high improvement. We are perceived in Iraq as the brand number one consideration when it comes to a mobile operator. AI, everyone is talking about AI. Just before we start, a disclaimer. I hate PowerPoint, I hate Excel, because Excel you can go do a goal seek. PowerPoint you can show a rosy picture of everything. For us in HSL, we have to present what we've done. We've been doing amazing. For the past couple of years, we've been working with AI, and it's been a journey, to be honest. And the way we look at AI is not a project. Today, I'm proudly happy and really happy to tell you that we have, as of today, are almost 15 up and running use cases. The way we looked at it is we looked into segmentation. We focused on our customers, and there is something called HSL Studio, where all the use cases that are related to customer and customer experience are built in that vertical. Then we have the corporate, and it's called Fanar. This is in huge cooperation with Ooredoo Group, building whatever use cases that can be built in a location and reused somewhere else. Then we looked at the network, because network is a major element for us on the way we look at and the way we deal with our customers. I'm going to pick two use cases just to show you the value and what it's bringing to the operations from efficiency. Layla is the agent that is a chatbot, but it's beyond that. The challenge that we had there is the language. We have English, Arabic, and Kurdish language. Today, Layla success rate and CSAT is hitting 80%. Customers are happy to deal with it. It got the emotional part, it got the language, and it's helping a lot. If I look at efficiency, because our CFO will look into efficiency when it comes to AI, there is a massive saving of potential expense that is coming. In Iraq, just for everyone to understand, call centers are for free. So the appetite for customers to call is high. And with Layla, with the implementation of Layla, we've been able to avoid major cost coming into that by increasing our customer agents to support the growth of customer base. If I look at network, today AI is changing the way we're doing maintenance. Right now, we have a prediction model within the AI that predicts failure on networks. And this shifted the whole way of our operation. Right now, we're not just doing preventive, we're following the prediction. The success rate of the prediction is almost 80%. This is extremely powerful. And the way we're doing our business right now is shifting from a scheduled type of a preventive maintenance into a proactive type of preventive maintenance that goes to the site with high prediction of failure. This is giving us also a leverage on having a happy customer with us, because we can predict the failure, we can fix it ahead of time, and it will increase, and it is increasing the customer satisfaction and their loyalty to HSL. Okay, and now for numbers. I love this slide, and this slide shows the power and the commitment and the dedication of HSL management to deliver shareholders' expectations, and sometimes to overachieve shareholders' expectations. Here we see, for over the past years, a very strong financial results, starting by revenue growth, moving into a profitable, sustainable growth when it comes to margin. Investment and the return on investment is extremely positive, with a high free cash flow coming into our shareholders. We're so proud to be part of Ooredoo Group. I'm personally proud of having a great management team that have been able to sustain this solid financial results for the past years. And I'm sure and confident that moving forward, we will be able to sustain such growth in the future. Thank you, everyone.
We now turn to Abdulaziz Al Babton, Chief Executive Officer of Ooredoo Kuwait. Ooredoo Kuwait contributes 13% of group revenue and 9% of adjusted EBITDA. Abdulaziz has been leading the operation since August 2020. The floor is yours, Abdulaziz.
Assalamu alaikum. Good afternoon, everyone. Welcome to Ooredoo's Capital Market Day, and I'm pleased to take you through the review of the Kuwaiti market. Our focus has been transforming the business into a more agile, digital, and high-performance operation, positioning Ooredoo Kuwait as a key contender in the transitional market. Kuwait is a dynamic and well-developed economy with a strong fundamental and a growing digital ecosystems. The population of the 5 million is young and tech-savvy. 22% are under the age of 30. And the growth of around 2% annually, fueled by naturally increasing expats inflow that support the mobile and digital demand. Economically, Kuwait remains resilient. GDP per capita is above the $30,000, with a projected growth of 2.7 annually throughout the year 2029. Inflation is moderate at 2.9, and the countries maintain a strong credit ratings alongside the stable foreign investment inflows and a strong currency. The mobile market is highly penetrated, with the 7.9 million subscribers sitting at 157 penetration. Consumers are increasingly shifting to postpaid and data-heavy usage, with the postpaid now reaching the 42% of the subscribers. With the Kuwaiti market, Ooredoo Kuwait holds the solid position of 38% subscriber shares and 30% on the revenue, replacing a key conductor. ARPU has been grown to $17.3, reflecting an improvement monetization and disciplines execution. The stationary broadband remains nascent, with penetration just under 40% and dominated by a single government-owned provider. While the segment remains small, it represents a long-term opportunity as a household digitalization accelerates. Building on a strong market foundation, Ooredoo Kuwait continues to outperform, grow the share, and supporting a strong ARPU, and reinforcing its position as a key contender in the competitive 3 market players. Ooredoo holds a distinctive 30% revenue share with a prepaid leadership and growing potential in the postpaid and digital services. Mobile drives nearly 70% of the revenue, with the subscriber growing from 2.5 million in 2020 to 2.9 million by the mid of 2025. ARPU has increased from $16.5 to $17.3, driven by a postpaid uptake among higher income and business customers. Operationally, Ooredoo Kuwait is high cash generated. Operationally, Ooredoo Kuwait is a high cash generative, supported by a strong top-line performance and disciplined cost management. Margin and cash flow are growing. Meanwhile, the customer mix shifts toward the higher value segments. Multi-play and the dual-play customers now represents around 70% of the base, around 85% of the revenue, and highlighting the success of our premium and converge offer. Building on our strong market position, Ooredoo Kuwait is strengthening its competitive edge throughout the network excellence and enhancing the customer experience. Network leadership remains a key differentiator. We provide a nationwide coverage with 98.6% on a 4G and a 90.4% on a 5G, supporting the growing data demand with an average usage rising from 58.8 to 75.2 gigabytes per month by year 2025. Our network performance is a top tier with Ookla speed scoring just below 1% below the strongest peer. And the traffic is balanced across the 4G and 5G, showing a healthy 5G transition. Our infrastructure investments are paying off. We hold 319 megahertz of spectrum, above the European average, with a strong site density and 68% fiberized sites, ensuring capacity, speed, and low latency. This positions us for the future upgrades and continued service excellence. Customer experience is a central of our strategy. We've been seeing a tangible progress in the 2 fronts. First, customer advocacy. Our net promoter scores has been raised from 37.1 in year 2023 to 48.5 in 2025. customer satisfaction scores remains high at 83.7, and the brand experience index continues to improve. Second, digital engagement is growing with My Ooredoo app users increasing from 1.4 million to 1.6 million, and digital recharge penetration rising to 48%, reflecting the growing adoption of our online platform. Together, these improvements highlights how Ooredoo's network is a strength, digital leadership, and customer-first mindsets are driven by real gain advocacy, usage, and brand consideration. As we strengthen our position in Kuwait, two areas are driven by value: customer value management and our expanding B2B businesses. In terms of CVM, it's a key competitive differentiator. Our AI-driven engine powers 100% of the campaigns, delivering a timely personalized offer. The impact is clear. Net incremental revenue is up 6.2% year to date. Postpaid churn has been dropped 15% and ARPU is rising, supported by the close collaboration with the dealers and partners. CVM shifts us from traditional campaigns to an AI-led value orchestrations, enhancing the engagement, loyalty, and measurable growth. B2B is gaining a strong traction, with wins totaling around $10 million across the public and private sectors. Highlights: in the public sectors, systems integration from Ministry of Interior in Kuwait valued at $2 million, a mobile account migrations from the Ministry of Defense worth of $1.9 million, and a range of connectivity and ICT solutions for the Ministry of Social Affairs. In the private sectors, enterprise solutions including Meraki networks, cybersecurity, and fixed connectivity, reinforcing the Ooredoo as an agile end-to-end provider. Launch of Kuwait's first dedicated B2B applications, transforming the enterprise telecom management with a real-time sales, marketing automation, and customer insights. The AI-led CVM and growing B2B footprint are driving sustainable revenue, deepening the customer's relationship, and cementing the Ooredoo Kuwait positioning as a digital leader in the fast-evolving market. Let's turn to our growth trajectory, highlighting the dynamics expanding of a strong financial performance. Revenue has grown steadily at 5.6 CAGR since 2020, driven by a customer base expansion, higher ARPU, and meaningful market share gains. Profitability is rising even faster. EBITDA has grown at 10.7 CAGR, with an improving margin, reflecting the disciplined and efficient operations. Our growth is underpinned by strategical investment and innovations. We continue to enhance our network, deploying and advanced technologies like narrowbands, IoT, all within the efficient CapEx to revenue approach. The strong execution translates into a robust cash flow profile, with the cash conversion improving from 47% in year 2020 to 72% over the last 4 quarters. In summary, Ooredoo Kuwait is driving profitability, growth in a stable, digital-savvy market. Strategical investments in network performance, digital services, and AI-driven customer engagements are boosting the satisfaction, market share, and ARPU. A strong operation efficiency and technological leadership are delivering the sustainable cash flow and a long-term value, positioning us for the continued growth and for capturing future market opportunities. Thank you. I now hand it over to Luel.
Finally, we conclude our country deep dive in North Africa with Ronnie Tomi, Chief Executive Officer of Ooredoo Algeria, who has been at the helm since August 2023. Algeria contributes 13% to both group revenue and adjusted EBITDA. Over to you, Ronnie.
Good afternoon, everyone. I'm happy to discuss Algeria market with you this afternoon. Algeria is quite a stable developing economy, expected to grow at 4 to 5%. The key drivers are sizable and young population and stable exports of hydrocarbon and other natural resources. The mobile market is rapidly expanding, driven mostly by consumption and penetration expansion. ARPU has been growing in recent years, again, driven mainly by consumption expansion. Ooredoo is number 3 player in terms of subscribers and is a very close number 2 in terms of revenue. Ooredoo in Algeria is a pure play mobile and predominantly prepaid operator with a strong history of ARPU expansion in previous years. As of H1 2025, we have served about 14.5 million customers, mostly prepaid. We are rapidly expanding market share and now contesting the number 2 spot in the market in terms of revenue. Our growth is profitable. We are expanding EBITDA margin while growing the revenue. We are the only international brand in the market well positioned to win among the younger and urban audience. 5G and device importation ban lift are the key drivers of our growth in the near future. Our network quality leadership is our key success factor in contributing to our leadership in customer experience, CSAT. We are nationwide leader in CSAT in the last 8 quarters. We continue investment into the network, focusing primarily on 4G coverage improvement and 5G readiness. Low fiberization of sites is an obstacle for us. However, in Algeria, we have to rely on incumbents' dark fiber. Digitalization of recharge and customer service channels promoting the usage of our app are the key current and future drivers of profitability and CSAT improvement. We have pioneered a very successful approach to network rollout. It combines AI-enabled data science toolkit that help us ensure optimal choices for network densification, which in turn ensure quicker payback and higher return on capital. Our main focus is to continue building and expanding our strongholds primarily in the center and east of the country, as well as tap into emerging potential of the south. Our commercial team ensures that full activation is done on day 1 from opening the new site, thus also accelerating the payback. To end with our financials, we have achieved almost 7% CAGR growth of revenue between 2020 and H1 2025. Last 2 years, we have shown double-digit revenue growth in local currency. Our EBITDA has grown by 13.6% CAGR. Margin has improved from 33% to 44%. It is a very profitable growth story. Our capex to revenue has gone down from 24% in 2020 to 17% in 2025. However, we are rolling out more sites and more efficiently than before. Revenue and EBITDA expansion paired with controlled capex ensure that we punch well above our weight in the Ooredoo Group free cash flow. Thank you all.
Thank you to our OpCo CEOs. Those were insightful market deep dives that showcase the strength of our local operations and their significant contribution to Ooredoo Group's growth and strength. I'll now hand back to Renee, who will provide an in-depth look at Ooredoo's digital infrastructure platform and discuss how these assets underpin our growth strategy as we progress toward becoming the region's leading digital infrastructure provider.
Now back to digital infrastructure as the second flywheel of our strategy. Digital infrastructure is like the blood arteries of the digital economy. Without digital infrastructure, there is no e-commerce. There are no cloud services. There is no AI services like ChatGPT or Gemini. So at Ooredoo, we're today already operating an essential component of the digital infrastructure with our high-speed networks. As such, it's a logical step to assess expansion opportunities in digital infrastructure. Infrastructure that is required to deliver to today's and future customer needs. For this, we applied a very disciplined process by which we identified for Ooredoo key opportunity areas. We usually start with customer needs and problems to be solved, as a promising business is always based on a big enough problem to be solved. Areas such as extended connectivity solutions, storage and protection of digital assets with easy accessibility, flexible compute capacity for enterprises, securing customers, SMBs and enterprises from a plethora of online attacks and scams. And we got that identified and channeled through assessments. We've prioritized from the pool of candidates 3 core infrastructure opportunities, with another option that we will also talk about, that Ooredoo is focusing on and where we believe we can provide a natural edge and already have assets in play. Data centers is one element, sea cable and transport fiber is the second element, towers is the third element, and also recently we started as a GPU as a service provider in our markets. We prefer, as part of the process, to establish those infrastructure platform opportunities into clearly identifiable P&L units, which open assets that have been used only for our internal demand, also for third-party usage, with a view to create additional value on the capital deployed. Allows us to establish clear entrepreneurial responsibilities with absolute experts and also partners in their field. Provides financial visibility with regards to progress, investments, and accretive returns, and allows to obviously also apply financial structures that optimize for shareholder returns and prospectively allow us to crystallize shareholder value. Ooredoo is and will be going forward always be a strategic anchor tenant to these assets and customer, but these platforms have to find and service demand at arm's length relationship with Ooredoo, meaning gaining customers from the outside. Finally, we scale these platforms, deepening the relationships we already have as a group that we can infuse into these assets, and secure new customer demand and driving strong and recurring free cash flow when these platforms are part of the group. Now let's talk about the assets in our second flywheel, digital infrastructure. With towers, sea cable and fiber, data centers, and GPU as a service. Let me first talk about towers. We're creating a joint venture with Zain and Task, bringing together with well over 30,000 towers across 6 countries, the largest towerco in the MENA region, and setting the stage for more and efficient, cost-effective rollout of wireless networks in the region, tapping into co-location opportunities as well as future consolidation opportunities that will create value for our shareholders. Given growth in data usage and the need to densify networks with additional sites or adding equipment to existing sites, as in our region some networks have to still make the next leap into 5G, we see towers as a growth opportunity even beyond the synergies from co-locating operators on a given site. Let's talk about the second pillar, sea cable and fiber. We have added sea cable and fiber as a clear investment focus for Ooredoo and a substantial infrastructure opportunity with attractive returns. We're driving major projects like the fixed subsea system in the Gulf region and a new intended partnership such as Sonic that allows us for both in-region connectivity in the GCC, among others to connect all of the AI data center hubs and the local economies, but also to establish an alternative to the key traffic corridor between Asia and Europe in the Red Sea that carries 30% of the global internet traffic and connects Europe with Asia. The established route through the Red Sea has become insecure, and the traffic on this route looks for alternatives, and safe avenues with the Gulf region is a very valid alternative, providing a home to this 30% of the global internet traffic, and positioning Ooredoo as a key data corridor operator for the region. In data centers, as the third pillar, we've carved out Syntys, now active in Qatar, Kuwait, and Tunisia, with Iraq and Oman, in addition, reviewed to join the Syntys family. We've partnered with Iron Mountain, a global data center operator in 61 countries and approximately 1.3 gigawatt under management, to leverage the expertise of an experienced partner for capital-efficient expansion of our data centers in the region. We're fully funded targeting to quadruple our capacity to over 120 megawatts of own capacity to meet the fast-growing cloud and AI demand in our markets, but also to be able to absorb global demand for AI learning and basically leveraging the competitive energy cost in the region. Sunita, our CEO for Synteos, will go deeper with you into this topic in a short while. Last but not least, GPU as a service. In GPU as a service, we are leveraging our network and data center footprint in the region to deliver low latency, cost-efficient AI compute, becoming the first GCC operator to launch GPU as a service and NVIDIA's NCP partner in the Gulf. This is a nascent and emerging offering, which we want to drive and see if we can drive this as an interesting fourth pillar of our digital infrastructure platforms. Together, these pillars form a connected, scalable digital ecosystem, one that turns our infrastructure strengths into sustained growth and, in particular, long-term value creation for our shareholders. Each of these four verticals is controlled by Ooredoo, or in the case of towers, will be co-controlled by Ooredoo. This enables value to accrue inside the group and leave open future opportunities for further value crystallization. Now let's take a moment to talk about the largest tower platform in the MENA region. We're progressing well on the transaction to form the largest tower platform in the MENA region. We've advanced the operational readiness for the transaction and are in close discussions with authorities on approvals for the transaction. To recap of what we're building here, together with Zain and Task, we're combining assets to create a platform with over 30,000 towers across 6 countries: Qatar, Kuwait, Iraq, Algeria, Tunisia, and Jordan, as we shared previously. The TowerCo will serve a population of 120 million and is supporting more than 20 operators once live. At announcement, the platform was valued at around $2.2 billion with an estimated 500 million in run rate revenues and 200 million in run rate EBITDA after leases, delivering strong margins of around 40 to 42%. Beyond scale, this transaction also establishes a clear framework for active sharing embedded in the agreements to accelerate rollout and improve efficiency across markets. We also see significant upside from potential consolidation in Iraq, where we expect strong tenancy and synergy benefits. After completion, further consolidation options remain viable that might also provide more in-market consolidation, giving the platform room to grow beyond the initial scale. Let me now talk about our sea cable and transport fiber activities. We're building one of the largest sea cable and transport networks in the GCC, positioning Ooredoo as a strategic gateway for AI and data traffic between Europe and Asia. The initiative creates a new corridor that connects the region to Europe with lower latency, a strategic alternative to the Red Sea route, which today carries about 30% of the global internet traffic. At the core of this system are 3 marquee projects that together form a comprehensive network. First, the FIG subsea cable system, which is under development with our vendor Alcatel Submarine Networks. FIG will connect key landing points across the Gulf. The project is already contracted, spans around 1,900 kilometers throughout the Gulf, and is expected to be completed by 2027. FIG will also open up options to connect the traffic that goes through FIG, through Iraq and Turkey to Europe and the Mediterranean Sea, and becomes a true alternative for the Red Sea. Second, through the intended Sonic partnership with STC, we're building a high-capacity terrestrial fiber corridor linking KSA and Oman and expected to be ready by 2027. In Oman, numerous cables from Asia land, and via the intended partnership of Sonic, subject to the approvals from the TRA, the local regulator, we can get an alternative route bypassing the Gulf of Aden. This system is expected to enhance regional traffic flows and provides simple cross connections for global operators. Third, Ooredoo is a landing partner to various cables and also holds capacity on various of these cables. So we have diversity in our assets. A recent addition is the Al Khaleej cable, connecting Oman, the UAE, Qatar, and Bahrain, which will further strengthen our position as a multi-landing hub with completion targeted for 2027. Collectively, these projects will make Ooredoo a key data gateway for the region, directly linking both regional and global networks and capturing growing demand from hyperscalers, cloud providers, and AI platforms. Now I hand over to Sunita, our CEO of Syntys, to give you an overview of our data center business and the opportunity in the region. Thank you.
Thank you, Renee. A key part of Ooredoo's growth story is our data center business, now spun off as Syntys. Already a market leader, Syntys is shaping the future of digital infrastructure. Leading the company is Sunita Botse, CEO since May 2024, who brings over 14 years of experience in digital infrastructure, including senior leadership roles at Microsoft and other leading data center companies. Sunita will take a deep dive into Syntys operations, highlighting the opportunities that the company is capturing and its vision for the road ahead. Over to you, Sunita.
Good afternoon, everyone. It's a real pleasure to be here with you today. Over the next 10 minutes, I will walk you through who we are, the market opportunity we are capturing, and why Syntys is uniquely positioned to become the leading digital infrastructure platform across the Middle East and North Africa. So let me start with the foundation. Earlier this year, Ooredoo took a strategic step forward, carving out its data center assets to establish Syntys as an independent digital infrastructure company, one fully focused on AI-ready data center solutions across the MENA region. This was an intentional decision to enable Syntys to act with speed, focus, and to be the operational flexible to scale in the line with market demand. Our mandate is clear: scale capacity, optimize operations, and build trusted long-term partnership that supports the region's rapidly growing need for cloud and AI infrastructure. So where are we today? By end of 2025, Syntys and Ooredoo together will operate 29.6 megawatts of capacity, and we have a defined path to reach 120 megawatts in the coming years. To get there, our total investment plan is $1 billion, of which $550 million is already secured. That's a strong vote of confidence in our strategy, our team, and our ability to execute. Our combined digital infrastructure today spans 5 markets across the region. In Tunisia, we operate 5 facilities with 2 megawatts of capacity. In Kuwait, we operate 2 facilities with 2.2 megawatts. And in Qatar, we operate 6 data centers totaling 60 megawatts with an additional 4.5 megawatts scheduled to go live by December of this year. The next potential phase in our carve-out roadmap may include facilities in Iraq and Oman, reflecting our ambition to evolve into a truly multi-market platform. Now let's talk about our performance. As of 2025, Syntys is generating between $40 to $45 million in recurring revenue, with $8.2 million in recurring EBITDA. These are preliminary figures, but they reflect real contracted revenue, the kind of foundation that allows us to scale with confidence. Our customer base already includes Microsoft and Google, and we are in active discussions with additional strategic partners that I believe will further validate the quality and reliability of our infrastructure. One of the most significant milestones this year was our strategic partnership with Iron Mountain. For those who may not be familiar with Iron Mountain is a globally recognized leader in data center operations with deep expertise in scaling infrastructure and optimizing performance across markets. Their involvement brings not only capital, but global operational playbooks, best practices, and strategic credibility, all of which reinforce our trajectory toward platform scale. To summarize, Syntys is at the beginning of a disciplined and ambitious growth journey. We have a strong financial foundation, high-caliber strategic partners, and a multi-market platform that is already operational and revenue generating. We are well positioned to capture the region's rising demand for digital and AI infrastructure. Now let's understand the markets we are operating in. The Middle East and North Africa region has reached an inflection point. Cloud adoption is accelerating, AI workloads are scaling, digital services are moving from optional to essential, and all of this requires infrastructure, skilled, reliable, and carrier neutral. Syntys was built for this moment. Let me give you some context on the market dynamics. Across MENA, data center capacity is projected to reach 3.3 gigawatts by 2030, more than triple the current capacity. This growth is being driven by a combination of factors: rapid cloud adoption across both public and private sectors, national digital transformation strategies, and the ongoing expansion of hyperscalers into new markets across the region. What makes this region particularly attractive from an infrastructure investment perspective is the combination of competitive advantages. First, electricity pricing in key markets remain highly competitive compared to other regions, a critical factor when you are operating energy-intensive infrastructure at scale. Second, capital availability is strong. Governments and private investors are backing large-scale infrastructure projects, and that support translates into faster deployment, timeless and strong project economics. And third, regulatory tailwinds are in our favor. Data sovereignty requirements are becoming more stringent, which means workloads that used to be hosted elsewhere are now being anchored locally. At the same time, we are seeing major investments in new subsea cable systems, which are significantly strengthening the region's international connectivity and making MENA a more viable hub for cloud workloads. All of these forces together are creating sustained, long-term demand for high-quality carrier-neutral data center capacity. And this is exactly where Syntys is operating. So let me walk you through our three core markets: Qatar, Kuwait, and Tunisia. And I will explain why we believe we are not just present in these markets, but strategically positioned to lead. So I will start with Qatar. Qatar is a maturing high-value data center market, and Syntys is the established leader here with 31% market share. We currently have 16.1 megawatts in operation. We will deliver 4.5 megawatts by December of this year, and we have 20 megawatts of expansions planned. We also have a long-term partnership and hyperscale commitments that provide stable, recurring revenue. In 2025, we enabled Ooredoo's sovereign AI cloud, providing the mission-critical infrastructure required to support GPU-based AI workloads, which is currently live. The market itself is being strengthened by the presence of major cloud providers. Microsoft Azure has been in Qatar since 2022. Google Cloud launched in 2023, and Oracle is now advancing its entry. All of this firmly positions Qatar as a strategic cloud and AI hub in the region, and we are at the center of that ecosystem. So now let me continue with Kuwait. Kuwait is a fast-growing data center market in the GCC, with a projected CAGR of 11.5% through 2029, the highest growth rate in the region. Syntys holds 20% market share in Kuwait and benefit direct subsea connectivity to Iran and Iraq. That connectivity is critical for scaling regional cloud infrastructure and enabling cross-border interconnection. Digital transformation in Kuwait is being driven by Vision 2035, which includes approximately $10 billion allocated for digital modernization. SITRA, the National Digital Authority, is playing an active role in supporting data center and network infrastructure development. And there are already large-scale multi-year developments on the way. What this means for us is that we are not entering a speculative market. We are anchoring capacity in a market that is structurally set up for sustained growth. Finally, Tunisia. Tunisia is an emerging market where we hold 25% market share with 2 megawatts currently operating. Why Tunisia? Because it provides something unique, a cost-efficient alternative to Europe, both in terms of capital expenditure and operating expenses, while still offering high-quality international connectivity. Tunisia already has 5 subsea cables in operation, with 2 additional systems under development, and it significantly strengthens the country's position as a regional hub. At the same time, the 5G rollout in Tunisia is accelerating enterprise cloud adoption, and the government is actively supporting digital infrastructure investment. But here is what makes Tunisia particularly interesting. From a strategic perspective, it's the location. Tunisia is a natural gateway, not just to Europe, but also to neighboring markets like Libya and Algeria. That creates cross-border revenue opportunities and position us to lead what could become a multi-country cluster play in North Africa. So when I step back and look at Qatar, Kuwait, and Tunisia together, what I see is not just market presence, I see strategic positioning. We have established market shares, we have active capacity expansion on the way, and we are structurally aligned with the forces driving digital and AI infrastructure demand across the region. That alignment matters because it's not enough to simply build capacity. You have to build it in the right places, at the right time, and with the right partners in place. And that brings me to the third part of my presentation today, how we are built to compete and scale. In 2025, we delivered 8.2 megawatts of mission-critical infrastructure, on time, on spec, and fully operational. Proof that we have a repeatable deployment blueprint that allows us to expand efficiently across markets. Our competitive advantage is built on 4 pillars. First, a regional, carrier-neutral, multi-market platform. We operate across multiple geographies, which means our customers, whether they are hyperscalers, AI clusters, or colocation wholesalers, can deploy capacity where they need it, when they need it, without being locked into a single market provider. That flexibility matters, especially in a region where digital infrastructure is still maturing and demand patterns can shift quickly. Second pillar, our AI-ready modular architecture. Our infrastructure is engineered for 99.999% uptime and aligned with global compliance standards. That means we can support everything from traditional enterprise colocation to advanced GPU clusters and high-performance computing workloads. As AI adoption accelerates across the region, that capability becomes increasingly valuable. Our third pillar is a robust contract model. Our agreements are US dollar denominated with 10 to 15-year terms and built-in renewal mechanism. That provides revenue visibility, protects us against currency volatility, and gives both us and our investors the predictability required to plan long-term capital deployment. Our fourth and last pillar is proven leadership. Our team has deep experience in scalable execution and operations. We know how to design and build data center, but more importantly, we know how to operate them efficiently, profitably, and at scale. These strengths are amplified by our strategic partnership. We are an NVIDIA cloud partner in the Middle East, and as I mentioned earlier, Iron Mountain holds a strategic minority stake in Syntys. Iron Mountain operates approximately 1.3 gigawatts of data center capacity across 30 sites globally. Their involvement brings not just capital, but operational maturity, global best practices, and credibility with international customers evaluating where to deploy infrastructure in emerging markets. Our go-to-market approach is clear and focused. For hyperscalers, we deliver built-to-suit infrastructure, tailored and designed to their exact specifications. For AI workloads, we provide mission-critical HPC and GPU cluster infrastructure that enables advanced AI application and GPU as a service delivery. And for wholesale colocation customers, we offer secure, scalable, cost-efficient solutions that allow them to grow with confidence. Looking ahead, our strategy is clear. We will continue to execute with discipline, partner with intent, and scale with purpose. Our roadmap to 120 megawatts is clear. Finance is in place and it's on the way. Syntys is not just participating in the region's digital transformation. We are shaping the infrastructure foundation that will enable it. Thank you.
So far, we have already talked about the first two flywheels or investment horizons for Ooredoo. Let's now talk about the third flywheel, platform adjacencies. Platform adjacency are, for us, mid to long-term investment opportunities where we test for opportunities with limited resource exposure before we scale based on proven demand. You could also call this internal venturing. To focus, we have rigor in the opportunities we select for experimentation, and we are highly selective in our choices. Less is more, in other words, solid execution, whereas a scattergun approach is what we're aiming for. We're moving here on 4 tracks in parallel. First, fintech. We're expanding both our proposition and footprint, embedding payments and financial service more deeply into customers' daily digital journeys. You might ask yourself, why? Some of our markets are still cash dominated. The economies are now ready to leapfrog into digital payments. Prepaid reloads are in these markets sometimes used as a form of payment already. As a key player in the prepaid market, we are well positioned as well to extend our position into digital payments and leveraging our strong distribution networks. Second area, APIs, or telco as a service as it's sometimes dubbed. With our ability to protect customers' data, to identify and avoid fraudulent banking or e-commerce transactions, to program our network, our industry is in a unique position to advance digital services. Unfortunately, our industry was unable to make these capabilities available on a global scale to digital service providers that operate globally. They are not interested in local solution. This has changed. Standards have been developed by standards bearers like TM Forum or the GSMA via its Camara initiative that allows standardized APIs to be used. Among the global telco community, Ooredoo is among the top certified telecom operators to provide APIs and has also joined both Aduna and the Bridge Alliance as a commercial partner. Those two associations market APIs globally to the digital service providers and represent about 4 billion customers of telecom operators. We expect that the monetization of APIs is at the early innings and represent a substantial growth opportunity considering applications in banking, government services, healthcare, to just mention a few. The third area is for us, again, platform businesses that are based on data science, which I want to mention here is AdTech, IoT, or data as a service. We are developing cookieless advertisement alternatives where we can qualify audiences but keep customers and customer data protected based on our network intelligence. We're scaling smart IoT metering platforms in various areas for utilities, for energy providers and water utilities, for example, for governments. We're launching data as a service as a platform where advertisers can run campaigns or small and medium businesses can through various channels that we can provide for their advertisement. Fourth, AI-led solutions for the enterprise market, which are under assessment. We're assessing currently investments into edge compute nodes in our wireless infrastructure, where real-time inferencing with minimal delay is required, such as for autonomous driving. As I said earlier, with GPU as a service, that's a natural fit for us. We are leveraging AI also for industrial video inferencing services with campus solutions, such as for chemical plants to avoid fire hazards with substantial impact to a production facility. We're also enhancing network-based security through AI-driven protection from hacker attacks, spam calls, or similar fraudulent activities. We have deployed this for our own end customer base already in Indonesia as one of the first telcos in the region. Together, these adjacencies expand our platform, deepen the integration across our ecosystem, and unlock new, sustainable revenue streams for Ooredoo. Let me zoom into one platform adjacency that is already up and running, fintech. Our fintech strategy is very simple. Develop once, roll out multiple times, and leverage the synergies with our core telco business with regards to distribution presence. Our fintech vertical is aimed to scale out internationally as a business model that we're already very familiar with, literally since more than a decade. In Qatar, we have launched fintech in 2014 and became the first licensed payment provider, processing over 6 billion in transactions today. In Maldives, we have launched our M-Faisa service in 2018. With this experience, we have also the introduction of a new fintech vertical. We have carved out the existing activities under one umbrella, under one P&L responsibility, and have successfully launched operations in Oman at the tail end of 2024 with our brand Valeti. In the first half of 2025, we were able to reach 50,000 registered and 50,000 active users as a first step and see solid growth continuing throughout the year. Licenses in Tunisia and applications in Iraq and Kuwait expand our next wave of markets. We hope to launch another market still this year as we progress also with regulatory approvals. We established for the new and existing operations a group of global partners in the fintech space, from PayPal to Visa, QNB, Microsoft, Ripple, and others, enabling interoperability and cross-border scale. Huawei is among our technical partners. The platform today delivers $22 million in fee revenues and has 329,000 active users, with a long-term ambition of 3 to 4 million users and $70 to $100 valuation per user. Our fintech vertical now has opened up further opportunities to also scale our business model into related opportunities, such as merchant payments, micro-lending, insurances, and digital banking, which we are reviewing as of now. We have by now covered all of the 3 flywheels, ladies and gentlemen, and the key strategic directions for these flywheels. Now let me hand it over to our Group CFO to provide an overview of Ooredoo's financial performance and guidance. Over to you, Abdallah.
Abdullah has been with Ooredoo since 2013, including serving as CFO of Ooredoo Qatar before taking on his current group-level role.
Hello everyone and welcome to the Capital Market Day. You have heard my colleagues share the success of our strategy and the direction that we are heading. I will now walk you through how this strategy has built our strong financial foundation. Before we begin, please note that the figures I will present are normalized and differs from our usual reporting. The numbers here are normalized for exceptional item and assume Myanmar was not part of our portfolio and IOH has always been treated as a joint venture. This approach will provide a clear view of performance for Ooredoo Group current structure since 2020. We have achieved a solid financial foundation by taking smart planned steps. Firstly, as Aziz mentioned, we have de-risked the portfolio of Myanmar and recognized IOH, allowing capital to be redirected and focus management attention toward higher return markets. Revenue has grown at rate over 3% since 2020 while improving margins. A new profit was up around 11% since 2020, reflecting margin expansion and disciplined cost control. This demonstrated that fast-growing countries drive strong growth while GCC markets continue to deliver strong cash flow. Secondly, returning are trading upward. Return of equity and ROIC have both increased by 5 percentage points. Third, our balance sheet is strong, with the investment grade rating giving us flexibility to invest. Our liquidity remains healthy, and our debt is well below the board's target range of 1.5 to 2.5 times. Lastly, we translate this strong performance into shareholder returns. This dividend has grown 160% since 2020, and the board has just approved an increase of our target dividend payout ratio to range of 50 to 70% of normalized earnings. A clear signal of confidence is that sustainability of our earning and bringing us closer to peers' payout ratio. To sum up this slide, we have simplified the business, improved financial discipline, and built a clear path for efficient operation to shareholder value. This foundation positions Ooredoo for consistent, high-quality growth going forward. Turning to the top-line performance, group revenue reached 24.1 billion riyals for the last 12 months period ending 30 of September 2025. Revenue has grown 3.3% year over year since 2020. This growth was driven by network investment, branding distribution, and churn management efforts. Revenue is diversified across mobile, fixed, wholesale, and equipment, with the mobile contributing over 71% of the group revenue, followed by fixed at around 18%. Looking at the revenue bridge from 2020 to 2025, you will note that high-growth countries have accounted for most of the top-line growth, primarily Iraq and Algeria, with a stable growth in Qatar and Kuwait. In Oman, results were affected by new competition, but we expect the market to stabilize as per Q3 result. Mobile service revenue was stable year on year. Overall, revenue growth is driven by strong country fundamental combined with operational excellence, and we expected this trend to continue. Adjusted EBITDA margin has been consistently north of 40%, thanks for our driven for efficiency and cost discipline. Adjusted EBITDA growth story is strong, supported by revenue, expansion, and cost optimization efforts. On average, adjusted EBITDA has grown around 4% per year since 2020. The high-rated GCC countries contribute around 53% of the adjusted EBITDA, while high-growth countries make an increased contribution of the balance. If you look at the bridge, you will note that adjusted EBITDA has expanded from 8.5 billion riyals in 2020 to over 10 billion riyal in the last 12 months period. This was driven by adjusted EBITDA expansion on the high growth countries, average over 8% growth per year. Adjusted EBITDA of GCC countries remain stable and as mentioned earlier. Results in Oman have been impacted by a new competition on the market. CapEx intensity has historically trended around low to mid-tens, we continue to make disciplined and strategic capital investment to drive growth. Since 2022, CapEx has increased around 16% per year on average. More recently, this now covers digital growth areas, not just a network CapEx. We prioritize CapEx efficiency with centralized oversight, driven high return investment, including digital infrastructure, over the last 5 years. CapEx has been equally split between GCC and high growth countries, with a higher share being allocated to the latter over time in the support of high growth. Free cash flow over the last 12 months decreased slightly due to additional CapEx, especially in a high growth market. Overall, since 2020, our free cash flow has increased around 4% per year on average, while GCC countries deliver over 60% of our free cash flow in the last 12 months period. The contribution from high growth countries has been rising. Free cash flow has expanded from 5.1 billion riyal to 6.2 billion riyals since 2020. Similar story to the EBITDA story. This is growth was driven by the higher growth countries, growing over 6% per year on average, compared to the GCC countries growing around 3%. Looking at the net profit, we continue to drive healthy net profit growth, which increased from 2.4 billion riyals to 3.8 billion riyals for Ooredoo shareholders since 2020. We closed the 2024 financial year with record earnings, achieving normalized net profit of over $1 billion for the first time. As a result, on average, we have seen net profit increase by nearly 11% per year. As mentioned, GCC market provide high cash generation. Qatar contribute 30% of revenue, but generates just over 44% of adjusted free cash flow. Meanwhile, the high growth countries has shown strong momentum in terms of growth, with countries like Iraq increasing its revenue contribution by 3.3 percentage points. The GCC countries make up just over half of our revenue, EBITDA, and free cash flow. The high growth countries make up the rest with the increasing contribution. This mix gives us a balanced growth, combining the steady GCC market with a fast growing ones. At Ooredoo, we are committed to maximize asset efficiency and deployment. On average, our return on equity has increased more than 5% points per year. In 2024, our return on equity of 12.4% was higher than the industry average of 11.7%. This is impressive, giving the group low leverage. Return on investment capital tell us a similar story, growing around 5 percentage points per year on average since 2020, and our 2024 figures of 12.5% is a significant higher than the industry average of 8.6%. These superior returns demonstrate our efficiency and disciplined operational mindset. Turning to the balance sheet, we have significantly deleveraged and de-risked our balance sheet. As per our latest result, we were at 0.6 times leverage, down from the normalized 1.7 times in 2020. Thanks to our strong focus on cash generation. As we are Deleveraging, we are benefiting from decreasing interest payment, which is decreased from around 900 million riyal normalized in 2020 to around 200 million riyal in the latest period. We hold investment grade rating from both S&P and Moody's. We have a strong liquidity profile and have been actively manage our repayment schedule. We maintain a strong cash balance and have significant underdrawn facility. Our debt has a long and spread out maturity profile, with the majority coming due 2030 or later. We are structured hedging against further rate increase, as 91% of our debt is on a fixed rate. Most of our debt is on the form of bonds. We are happy to know that we are recently repaid the 2025 maturity of $750 million principal of a bond on the 19th of October. Turning to the shareholder returns, Ooredoo has maintained a sustainable and progressive dividend policy. Historical payout moved to the upper end of our 40 to 60% policy range, with a dividend increase by 160 from 2020 to 2024. Reflecting our confidence on the group future cash generation, we are raising the budget payout ratio range to 50-70%. This policy reinforces our commitment to balancing growth investment with attractive and sustainable shareholder distribution. Our strong cash position and prudent leverage enable us to maintain flexibility while generating results for our shareholders. To conclude my section of the Capital Market Day, I will present our outlook and guidance. Group revenue reached 18.2 billion riyal, growing 5% year on year when excluded impact of Myanmar exit. We expect to meet the full year 2025 revenue guidance of 2% to 3%. We deliver solid EBITDA margin of 44% and expect it to be in line of our full year target range in the low 40s. CapEx stood at QR 2.8 billion, up 46% year on year, keeping us on a track to maintain our guidance range of 4.5 to 5 billion riyal. Our full year guidance remain unchanged, with full year 2026 outlook expected to align closely with full year 2025 guidance. The strong 9 months performance, combined with our healthy financial position, clear strategy and accelerating momentum, reinforcing our confidence in the long-term growth trajectory. Thank you for your time. Now back to Luail.
Thank you, Abdullah. That was a clear demonstration of our strong financial discipline and growth trajectory, and how it continues to deliver sustainable long-term value for our shareholders. Before we head into Q&A, I hand over to Aziz for his closing remarks.
To conclude our Capital Markets Day, you'll have seen that Ooredoo's financial profile aligns with best-in-class operators, both regionally and in developed markets. As I usually emphasize, we believe Ooredoo remains significantly undervalued relative to both our developed market peers and particularly our regional peers. The market today sees us as a traditional telco, but the reality is we are a portfolio of distinct high-value digital assets, which each vertical reflecting its own value and multiple. Our core telecom business is the bedrock of our business, a powerful cash generation engine with a balanced mix of stable and high growth markets. Furthermore, our portfolio includes premier infrastructure assets spanning across data centers, towers, and fiber. These are high growth, high yield businesses. Layered on top of this is our high growth fintech platform, our powerful catalyst for future value creation as we continue our expansion into key markets. Despite the clear premium valuation of these individual parts, Ooredoo trades today at a discount. As you've seen from our strategy, we've reorganized the business to unlock the full value of each of our verticals. Let me leave you with a final thought that captures the essence of Ooredoo and the compelling presentation we've shared with you today. Ooredoo is not just one story, it's a unique and powerful combination of three. The stability and strong cash generation of an established market leader, the high growth potential of our emerging markets and new digital platforms, and clear, actionable strategy to unlock the latent value embedded in our world-class infrastructure assets. We have the right strategy, the right assets, and the right team to execute this. We are more confident than ever in our ability to deliver the next chapter of growth and to create substantial long-term value for our shareholders. Thank you for joining us. Looking forward to the questions.
Thank you very much to all our presenters. We've now reached the much-awaited Q&A segment of today's event, and here's how you can participate. Raise your virtual hand, and I will unmute your line when it comes to your turn. Alternatively, type your questions in the Q&A box, and if you're dialing it by phone line, please press *9 to ask a question. For the Q&A in the room, I'm joined by the management team that you've just heard, and virtually we have Aziz and our Deputy CFO, Iyas Assaf, online. Okay. Our first question, we have two hands raised. Our first question comes from Thando Skosana from UBS. Please go ahead, Thando.
Hi, good afternoon. Hopefully you can hear me, and thank you so much for the presentation. A lot to digest today. So I'll start maybe with three questions because I've got a couple. The first one is just, in terms of your medium-term revenue and perhaps EBITDA margin guidance. I wonder if you could give some more color in terms of what do you expect there. Should we continue expecting, that sort of low single-digit growth, or does this now become mid-single digits? You did give a split between, core telco, digital infrastructure, and platform adjacencies. The second question is just on, cost savings that you've spoken about. I wonder if you could also provide some color or quantify what you guys expect in terms of cost savings over the next 5 years, and then where you see, in which areas you see opportunities to do more cost savings, please. And then my last one is just on Iraq. You just speak about fiberization of your sites. I wonder if you've already started here, or is this something you still need to start in the next coming quarters? And maybe if you can talk about CapEx as a result of that fiberization. Thank you.
Thanks, Thando. Aziz, would you like to start?
Yep. Good morning, everyone, and sorry for not being with the rest of the teams. Some of the events of the job took me outside the country. Look, regarding the medium-term EBITDA margin, we've announced around 4 years ago, we said we want to get to a low 40s threshold. We're now close to the mid-40s. We're at 44% EBITDA margin. Our goal in the medium term is to exceed the mid-40s and to be between the mid-40s to 50, so around 46-47% EBITDA margin on a run rate basis. Regarding cost saving, look, we're constantly looking for efficiencies across our business, whether it's operational efficiencies, looking at in-house services versus out-house managed services, constantly trying to push our procurement efficiencies. Also, cost of sales. There is no single magic bullet. We've done that exercise the first 2-3 years. We're now at the marginal incremental gain, and it's a recurrent exercise of constantly reviewing our costs, whether
cost of sales or operational cost. A big help in cost of sales is through digitalization of sales and distribution channels, which in certain of our markets, as the nature of the market are still not fully mature, so there's a bit of extra juice we can get there. For Iraq, I'll let Amr answer.
Yes, that one. Go ahead.
Yeah, on fiberization, spot on. Yeah, this is a thing that we are working on right now. Our strategy on fiberization is clear. We're going 1 to 10 hub per 10 sites to have fiber. It's a challenge in Iraq, just for everyone to be aware. Fiber is owned by the government, and whatever fiberization we do is basically with the support of the government. Investment is there. We have our rings. And whenever we have a challenge, right now we're investing more and more into the E-band. E-band supports us on a fiber in the air as a technology. Right now we're running out on that one. But the strategy is clear for us. We're moving ahead with it, and we are fulfilling our strategy when it comes to fiber. Maybe the demand will come more and more when we go to 5G. Right now we're waiting for the government to issue the license on that one. But in general, 5G will drive the more demand on fiber.
Thank you, Amr. Our next question comes from Maddie Singh from HSBC. Please go ahead, Maddie.
Yes, hi. Thanks a lot for taking my questions and a great set of presentation. I do have a few questions. Should I just give them all now, or should I do one by one?
Do them one by one, Maddie, please.
Okay, all right. So my first question actually is on Algeria. You used to be, I think, number 2 operator in Algeria, and I saw in the slide, it's now number 3. So if you could, discuss, the outlook in Algeria, is there a path to go back to number 2, and what needs to be done to get there?
CapEx investment. Our sites are rolled out based on cluster approach and in-house data science model, which give us also competitive advantage, and our strength in CVM and data science, which will provide to our customer the best products and optimize sales and distribution. Plus, in addition to that, our B2B, we will empower B2B and ICT offers. So for Algeria, we believe strongly that very soon we will be a solid number 2 player in the market.
Thank you, Rani. Maddie, you want to ask the rest of your questions?
Yes. So the second question is on Kuwait. So I noticed your subscriber share and revenue share actually have a huge gap. So again, if you could discuss, what's the reason behind this, gap in the revenue share versus subscriber share, and what can you do to bridge this gap? And is there a risk of like some market share loss if actually you want to, let's say, improve your revenue market share there? Thank you.
Yes. Good afternoon. Actually, if we go to the details of the revenue itself and the market share when it gets to the subscribers, there are so many things in the details in here. The subscribers is basically the prepaid and postpaid, and this is majority of the country is going into 80%, roughly 75 to 80% prepaid. So the revenue that you're looking at, it covers also the fix and covers the other ICT services and so on from the 3 companies. If you go to the details, you will see that the service revenue, which is coming close to the reality, it will be way closer to the other operators. And the number of subscribers you're here as a standard of telecom, they're reporting the subscriber to the network on the GSM. So maybe a detailed can be explained later on if it's not available, I think, in the business, but we can provide it hopefully.
And if you could also give some color around the current regulatory, situation. Has the interconnect rates come into the market? Is there any other major regulatory changes which we should expect in Kuwait?
Okay. Actually, it's a good question because the picture of Kuwait, when it gets to the last year, the stability has been there, especially after the changes in the government level. So we've been seeing a good, I think, indicators that things are moving in the right direction when it gets to the stability and going into the prices and going into the options and features. So being in this market as CEO for the past 5 years, I can tell you the last year was one of the best years that we've been having kind of like communication in a high level and guiding the government itself as a private sector has been kind of tailored and communicated very well. Talking about the prices, the whole country to revisiting the prices, and I think the telecommunication is a one major thing which will be was promised to you that inshallah we will see some improvement in this area. Great. Can I keep going or I have to stop?
Yeah, sure. Go ahead.
Okay, thanks. So the third question is actually on Iraq, where the issue I think is opposite. You have lower subscriber share but much higher revenue share. So I wonder, do you see any risk to the revenue market share? Like somebody comes in with a price competition, could that be a risk? Yeah.
Yeah, thank you for the question. I mean, you're taking us by sequence right now, each one of us. But if you look at our strategy is clear. We're not behind just being number one for number of subscribers. I mean, for us, we focus on value customers. If you reviewed the presentation, what I went through, we have a couple of areas that we're focusing on. The multi is one of our major drive that we're going there. This is creating real value for us. On top of that, we have lots of adjacent services that we're doing right now that we're developing in the market. We're unique in that one, and customers, basically, they really love our services and they're attached. If you look at even churn rates, it's extremely low compared with our competition. On top of all of that, when you look at the distribution channel, what we're doing right now is not acquiring customers, as Renee said, for the SIM card. We're just getting customers, making sure that they will deliver value for us. So in general, our strategy is focused on revenue and good margins by creating value to our shareholders, and this is where we drive. And we've been doing that for the past years. I mean, if you look at our history for the past years, we're number one by far on the revenue, EBITDA, free cash flow, and even net profit compared with our competitors. So it's a strategy that we've adopted long time ago, and we're still holding to that strategy.
Understood. The next question is on data centers, if I can. I noticed that. Sorry about that. Sorry about that.
See us. By one, Renee, get ready.
The question actually is on the, I noticed that, you plan to invest about $1 billion, but the ambition is to get to 120 megawatt plus capacity. Is there any significant difference in your costing, like the capex required for the purpose of building these data centers compared to the global peers? It seems like you are lower than peer on a per megawatt basis. So, what are the reasons and drivers behind that, if you could share that? And this is especially given that you're focusing on GPU as a service, high-end services as well. So if you could talk about that. Thank you.
So thank you for your question. So our CapEx investment differ per country. So if you compare the CapEx for Kuwait or Qatar or Tunis is on the lower end. That is the reason why the number, if you compare it with Europe or US, where we have around 14 million to 70 million US dollars per megawatts, it's a little bit lower in this region. And the reason is that when we build on skill, we can have the economy of the benefit of the economy of skill, as well as we work with our preferred partners, which we have great relationship with, where we can get better prices. And we also make sure that we order our equipment in advance, whereby we don't have to wait, but there is a lot of constraints and the prices are might be going up because of a lot of demand. So there are different factors, as well as the labor cost. That is also one of the costs that, of course, is like your design, your engineering, your construction. These are also driving all the prices for CapEx, and that is also different per country. So we took an average across our countries that we are aiming to expand.
Understood. Can I keep going or should I stop, Louis?
You can go in.
Okay, great, thanks. So the next question is on actually Tawal. So,
given that the approvals are yet to come, I was wondering, when are you expecting the financial separation, or that has already happened? Because what the question I'm leading towards is there any indication around the impact on expected, margin impact, or let's say income statement impact after the tower deal is concluded? So is there any color you could provide on that side? Thanks.
So, Mehdi, since our results report, which was a few days ago, the answer really hasn't changed that much. We've gotten verbal confirmation that everything should be okay. So we're expecting, with our breath held, to get final written confirmation to be able to close the first marshal, which is Qatar. Realistic timeline is, if we get anywhere the approval in the next few weeks, we should have a first closing early Q1 of next year. When it comes to separation of accounts, we are running internally separated accounts. We don't report pro formas till the transaction is closed. Especially, there are quite a few adjustments due to the size of portfolio since we announced the transaction. One thing that hasn't changed much, and I know you were there a couple of years ago during our Capital Markets Day, we spent a lot of time on what would be the impact to our financials on the TowerCo model. And happy to, first invite you to go back to that presentation, and happy probably at the first closing to run you through an update of the final impacts of the first close.
For sure. The reason I asked was because since then we have had a couple of transactions in Saudi where the treatment actually has been slightly different. Like both Zain Saudi and STC have taken a more like a service, managed service, route to the accounting, which basically meant that they didn't have any real negative impact on earnings. So just wondered, whether you are exploring that model as well. So that's why I flagged that.
Look, we believe that this transaction is value accretive for our shareholders, both in terms of crystallization of value through the crystallization of a yielding asset from idle infrastructure, but also from an earnings standpoint. But don't worry, we are looking internally and also with our external auditors of the best accounting treatments to maximize performance for our shareholders.
Understood. My final two questions, I'll just give them together. The first one is for Aziz again. Stock liquidity, that has been a major, I would say, investor feedback to us that it is low, it's still low enough. So is there anything which is in the pipeline, or you think you can do to help on the stock liquidity side? So that's the first one.
I think Ooredoo was the first company in Qatar to actually enlist market makers around their shares to increase the liquidity profile of its shares. As you know, we have a structural part to our liquidity we have three strategic investors accounting for close to 75% of total shares, which is QIA with a bit more than 52% or a bit higher, 52%, the pension fund, and ADIA with 10%. So as you've known, we've been in discussions with the different pools of these strategic shareholders to explain and educate them that a small release of certain shares would probably unlock liquidity benefits, which also would reflect in our indexation within the MSCI. And just the re-rating within the MSCI would probably add half a turn to a turn of multiple within our valuation. As you've seen during this presentation, and it's a deep belief of myself, we are in a number of metrics, but best in class in terms of a telco. We're definitely in the top quartile in terms of but profitability, in terms of free cash flow. We have one of the strongest balance sheets in the industry. We've got a lot of valuable accretion during the last 4 years. We've doubled the market cap of the company, but we've never had a multiple accretion. And this is due to exactly as you highlighted, the liquidity profile. Then to your last question is there any liquidity transaction coming? You know very well, Mehdi, the rules of the game is we can't pre-announce a transaction till a transaction is actually confirmed and good to go. So I can't comment on that. Regarding pricing outlook, look, in all markets, we strive to avoid first price wars. We also, one of our big push, and I think we've demonstrated it across nearly all of our footprints, we've been able to drive significant ARPU growth. And part of that is to drive some pricing discipline. We were in a number of markets, whether it was Indonesia, Iraq, you have a number of the CEOs here, unilaterally the only telecom player to withdraw, for instance, unlimited plans, which are value leakage in terms of the whole pricing model, hoping that the other operators would follow, and in many cases they followed suit. So we do try to enhance market repair. Now, on that, I'll let René take a bit more and expand on that point.
Right. Thanks, Aziz. Look, we differentiate by customer experience. Our focus is not to differentiate by being the cheapest in the market, as Aziz was already saying. The point is, and you've seen this on the presentation as well, we're in the fortunate position that in our markets, we have favorable price elasticity. That means more data usage equates to ARPU growth, equates to more top line. So we're still fortunate in driving this. Third item in there is as well, we are very focused on driving growth through CVM. And that is not price discounting. This is selling additional services to our customer. This is where our focus is. And this is where we center on growth at OB. Again, I just want to repeat, our focus is happy customers, great customer experience. And that means you don't need to be the cheapest in the market. I hope that answers the question. Understood. Thank you very much all for your patience. Thanks a lot.
Yes, we appreciate the question. We have a few typed questions, and I think I'll start with the data centers. So on data centers from Nitika Gupta from Franklin, so the target of 120 megawatts capacity backed by the $1 billion investment, could you share more on demand and pipeline? Are these data centers being built on confirmed customer contracts, or are they capacity build-out expecting future demand? How quickly do you anticipate ramping up utilization at new sites, and what is the current utilization levels?
Thank you, Nitika, for your question. It's a mouthful. So let me answer your first question, the part of the first. It's about our demand and pipeline. So basically, our main target group is the hyperscalers. So we build based on their specification. So it means that we don't build speculative for hyperscalers. Why? Because technology is changing really, really fast. So for example, we have traditional air cooling. Now today, there's a demand for liquid cooling. So if you would build your data center based on these traditional specifications, for example, for air cool, then you would have an asset which you cannot utilize. So today what we do is we work closely with the hyperscalers. We design the data center according to their specifications. We build it and we operate it accordingly. So that's the first thing. Secondly, for our multi-tenant, we can build speculative because today we still see the low densities per rack. So that is something that we can predict for the coming 2 years. So and then for the AI infrastructure, it's also quite custom made because the density, let's say last year we were talking about 25, 30 kilowatt per cabinet, but today people are already talking about 120 kilowatt or even more than that. So to build that speculative is really capital intensive. So that means that we just communicate with our clients what they want, and then we will build accordingly. And then I think the second question was about the ramp up. So our focus is to scale to 120 megawatts by 2030. So apart from the hyperscalers that are our clients today and that we are operating the facilities for them, we are also in discussion with other clients, which I cannot mention the name, So we are in advanced discussions. We are also evaluating across our 3 countries multiple sites for expansions as well. So we aim to achieve our target by 2030.
From Rian Durman from Ashmore. For Synthos, can you provide some color on the megawatt capacity ramp up? For example, do you have a target each year to reach 120 megawatt capacity?
Yes, so we have an capacity ramp up plan based on our pipeline. So next year we will expand with additional 20 megawatts. So we will do our groundbreaking next year for a new facility, which will be fully dedicated to one of our hyperscalers. And then, as I mentioned earlier, we have additional discussions on the way. So we will reach our 120 megawatts by 2030. And of course, it would be great if you could exceed that number.
Okay, great. Next question is on GPS service from Rajan Natharajan and from Sancta Capital. How CapEx intensive service?
So I think this question is partly for me and partly for my OpCo CEOs, because we as Synthos, we deliver the critical infrastructure. That means that we deliver the power, the cooling, we design the data hall based on the customer's requirements. And the customers are mainly the public and the private sector, which our OpCo CEOs are dealing with directly. So it's quite capital intensive. But when it comes to the layer on top of the critical infrastructure, that is the CapEx related to the OpCo CEOs. So maybe one of them would like to take away it, or Renee.
Yeah. Look, the prices for NVIDIA chipsets are known, so I will not tell anybody a secret about this. In addition, you have to do some, let's call it IT planning and orchestration. Again, the bulk of the cost asset is the infrastructure enablement in the data centers, as well as the chipsets. We're working on this. We will not disclose for commercial reasons the pricing here. I hope you understand that.
Isan, next question is from Rawan Shaker from Sikobay. 2026 guidance is similar to 2026 guidance or flat to 2025 numbers?
Maybe I'll take it. Or
as you can start, then Abdullah will.
Look, in general, the hotspot. Okay. In general, guidance, as you know, we can't come out with guidance till it's been ratified by the board. And the board meetings where we issue guidance is upcoming in Q4. So as of today, as much as we know as a management what we're recommending to our board in terms of guidance, we cannot outline it publicly today because it still hasn't been ratified by the board, and the board might ask us to change our guidance. That being said, if you look at our historic curves, we've always been a bit on the prudent side when it comes to guidance, and second of all, we've always exceeded our guidance.
Please. Don't see any more questions. I'll just give it a minute. Okay, no further question. So that concludes our Q&A session and our 2025 Capital Markets Day. If you have any additional questions or require any further clarity after you've digested the detailed content, please feel free to reach out to me directly. We really do value your feedback, so a short survey will pop up after the webinar. Please could you take some time to fill it out. Thank you very much for your time, attention, and your continued interest in Ooredoo. Thank you very much.